Welcome to our live stream, and we have an hour together. And let me just say that we're quite excited at the moment because we've offered a new tool. We soft launched it, and this is for our PensionCraft website premium members. And if you join our membership before we put up prices next year, remember we haven't put up prices for our membership, I think, since 2021. So in real terms, we've taken a roughly 30% cut in our income, but we will be increasing the subscription for new members, not existing members, sometime in the new year. So if you do join our membership before then, you can lock in the low rate right now. And let me just quickly explain what this new app lets you do. This lets you enter your own portfolio and backtest it to see how it would have performed historically, but also to do Monte Carlo simulation and predict with error bars roughly what return and risk to expect in the future. So it's conditioned on the past, of course. It's simply a Monte Carlo simulation, but it is quite useful in working out reasonably what kind of reasonable estimates you've got for your future savings for a given portfolio, and also what would happen in drawdown once you're taking money out of your portfolio. How long will the pot last? So we're quite excited about that. Our members have tried it out, and of course we'll be developing it with feedback from the community. So it's just going to improve over time. And we funded this ourselves out of our own pensions, I guess. So it's not subject to any kind of VC capital or any of that. So if you do want to try it out, if you do want to join our community, then you can find out more. Just go to pensioncraft.com/membership, and you can try out that tool. And let me just also share with you our Many Happy Returns podcast for this week. Always a good one, but this one was good. Maxed out markets, investing when everything is expensive. Because of course at the moment we're in this state of euphoria where Trump has been elected, risk assets have gone crazy, Treasury sold off a bit and then they kind of recovered. But generally it's been taken very well indeed by markets. So if you own something like VHVG, which is the fund which I use for developed markets, if you look at the price of that, it's been rising quite sharply recently. So it was bouncing around for most of the summer and the autumn at around what, 82 pounds per share, and now it's gone up to about 87, 88. So why is that? Well, partly because of sterling weakening versus the dollar. This has been a period of dollar strength, and simultaneously we've seen US markets, which make up 70% of this index. They've gone up hugely. So we're at close to all-time highs for the S&P, the Nasdaq, the Dow Jones, my least favorite index, but generally very positive for risk assets. So that's why we asked that question during the podcast. Maxed out markets, investing when everything's expensive. And the dumb question of the week is why Warren Buffett is holding so much cash, because that's also at current all-time highs, which is slightly in the face of what's going on in risky assets. So let me switch back to me. There we go. And we'll turn to your questions. Now, previous live stream, somebody called Alberto had 3 super chats where he paid for those 3 questions, but it was after the end of the session, so I didn't see them. Or actually it was before the beginning of the session. And for some reason we couldn't see that when we were looking at the list of questions. So I'm going to start this week, quick fire round on those 3 questions from Alberto. So I just hope he's watching or he's going to watch it in replay. So the first one is, are dividends irrelevant? If a company pays 1% dividend and the value of the stock falls by the same amount, how does reinvesting the dividend make a difference if the value of the stock falls? Is it a return of capital? It all depends on whether that company, if they hadn't paid the dividend, would be able to invest it at in an accretive way, which would have increased their revenues. If you think that's the case, then maybe paying out the dividend wasn't such a good choice. But if you think about it about your choice, whether to reinvest the dividend, The question again is, by reinvesting the dividend, can you generate a return that would be higher than the return of your overall investments? So, would the dividend reinvesting make a difference? Well, it makes a huge difference long term if you do reinvest versus if you don't. But when you're thinking about the paying out of a dividend by a company, the question is always, if they've kept the money, could they have reinvested it better themselves and generated a larger capital gain than if they'd have paid you the money as cash? So that's the real comparison. So that's the way I'd think about it. But rationally, economically, the paying of a dividend should leave you indifferent, because whether you receive that capital and reinvest it back into the stock, or whether they reinvest it back into the business, assuming they reinvest it well, then you should be indifferent as to which outcome you get, whether it's total return in terms of cash plus capital growth, or whether it's all as capital growth if they'd reinvested it. So in that sense, yeah, dividends don't really matter. What certainly doesn't matter is the timing of when you buy the stock. Now, people also ask this about money market funds. They notice that if it's an income-paying money market fund, it falls by the amount that it's paying on the ex-div date, after which you're not entitled to the dividend. So that's why it doesn't really matter when you buy, because if you buy just before it goes ex-div, you just get a higher price. If you sell just before that, you get a higher price. If you sell just after, well, you've got the dividend, and so the price has gone down to adjust. So it's like the dirty price of a bond in that sense, which means the timing doesn't really matter. So this is why when people talk about dividend investing, people always say, oh, that's such a basic misunderstanding of how economics works. But in fact, I can see that people may not trust the company to reinvest back into the company in an accretive way, and they just prefer the cash themselves. They think they can do better with it than reinvesting into that company. So I think that's the real argument. How well will the company reinvest the money? How well will you reinvest the money? And should it go back into the stock or to your broader investments? So I don't think it's a clear-cut answer to those questions. Really depends how you invest it and how the company invests it. Next question from Alberto is, I'm waiting and hoping for a stock market crash to happen. Please tell me about a circuit breaker in trading, what can cause it, and also what are the consequences? Well, it isn't always the case that there have been circuit breakers. In the past, it was an innovation for stock exchanges. The reason why they introduced it was because if there isn't a circuit breaker, when you get a crisis and you get panic selling, it's usually selling people worry about, then lots of people, when they see the prices plummeting, they'll carry on selling. And so it becomes a self-feeding frenzy of selling. And there's nothing to stop it. Markets go into free fall. And there's just panic and blood in the streets. So how can you stop that? Well, what you do is, after markets have fallen by a certain amount and a certain period of time, and I'll talk about the actual circuit breakers in practice in a minute, but if that happens very rapidly, the fall in price, then markets basically shut down trading. And they say, look, time out, you just calm down a little bit, rethink about what you're doing, look at this price, it's looking really good now, maybe you want to start buying instead of selling. So it just gives everyone a chance to calm down and create these circuit breakers. Also, if it's got stop losses, maybe it would stop those things triggering and give markets a time to kind of readjust and start some kind of buying activity which support markets. So the actual circuit breakers, for example, it depends on the exchange and the index, but for example, for the S&P 500, you've got 3 levels of circuit breaker, and if the S&P 500 index drops by 7%, that halts trading for 15 minutes. If it then falls by 13%, you get another 15 minutes. If it falls by 20, you then get trading halting for the rest of the day. But if it happens after 3:25 p.m., pretty close to the end of trading, trading continues regardless of the decline, because presumably markets are going to be shut soon anyway. And you've got single stock circuit breakers for the same reason, right? They call it limit up, limit down, LULD, and trading's pause for 5 minutes if a stock's price moves up or down by more than 5 to 10%, and that depends on the stock, the size of the move, and the period over which that happens is a 5-minute period. So markets are continually monitored to see if we break these circuit breakers, and if we do, these circuit breakers kick in and people get a chance to calm down. So that's the purpose, really. And I think it's good because it ensures that markets remain orderly, that you don't get these disorderly sell-offs when people panic and we get these crazy market dislocations, although that does produce opportunities, to be fair. Final question is, what happened with Russia funds? How come the savings of those who invested are gone? Where did this money go? Were Russian bonds also affected? Can it happen with any country or only in dictatorship? Interesting question, because there have been periods in history when markets, entire markets, have gone to zero. And your question about where does the money go? Well, it disappears. Literally, the money is crossed off the global balance sheet. So stock markets can do that, and single stocks can do that. They can go to zero and essentially destroy money, which seems odd. People often think of money as something which can't be created or destroyed, like energy in physics. Well, it's not like energy. It's not conserved. You can destroy money. And in fact, in the case of the Russia funds, it destroyed quite a lot of money. Now, there were things, for example, Russian bonds. Some of my clients, in fact, were affected. They bought Russian bonds because they offered a very high yield. And the effect of those sanctions was that these bonds became almost worthless. There was a slight loosening of the rules, the rules which essentially meant they couldn't be traded. And this was imposed by, I think it was the US tax agency. Let me just quickly pull that up. Yeah. So in the case of in the case of the US, it was the US Treasury which provided new guidelines in July of 2022, and that meant that US holders of Russian debt could wind down their positions. So there was limited trading in these bonds, which allowed them to sell, not to buy, of course. However, it was still a very illiquid market. No market maker wants to do that, right? So the prices would be marked down very dramatically. So at least you could have recovered some of your value, but probably not much. So to answer your question, what happened to the money? It disappeared. How come the savings of those who invested are gone? You made a risky investment. You lost your money. That's just the way it works. Where did this money go? Into the ether, right? It just disappeared. Russian bonds were affected, sovereign and corporate. So a lot of Gazprom bonds, for example, the energy supplier, the energy producer, that those disappeared. Very big dividend payers, the equity and the bonds. So they were quite popular with people who wanted income, high income, and of course they disappeared. Fortunately, if you look at emerging market indices, Russian weighting was quite small, whereas if it was a country like China that defaulted or was subject to very severe sanctions because it invaded Taiwan or something, that would be a much, much, much bigger impact because it has a much bigger weighting in EM bond indices, for example. And also systemically, it's a much more important country economically. Could it happen in any country or only in a dictatorship? It can happen with any country. For example, with the Russian Revolution, the entire stock market went to zero. You could argue that the Russian Revolution was the will of the people. So I'm not sure it was democratic. It was kind of, I'm not sure what you'd call it, but it wasn't contrary to the will of the people, put it that way, or the majority of them, arguably. But it did put the price of all Russian stocks to zero. And one of my clients actually sent me a Russian bond certificate, which I actually love because it's got the coupons, and only the first coupon got cut out because that's how you got paid a coupon. You'd have all these little tassels on the bottom of the bond certificate. You'd mail them in and get sent back cash. Well, only one of them got sent in, and it wasn't redeemed because the default happened on that first coupon payment, which was interesting. I love that bond certificate. But it could happen with any country, yeah. But dictatorships, it's more likely that they're going to repudiate their debt. Now, remember that the president-elect has actually suggested at some point that the US might be able to default on its debt, and that would be kind of okay. Well, actually it wouldn't. So let's just hope that sanity prevails and that the US doesn't do that. But it has been discussed, and some people have actually said it would be okay for the US to repudiate its debt to foreign bondholders, not realizing, I think, what the repercussions of that would be, which would be catastrophic for the US and for its cost of debt, particularly given the amount of outstanding debt which the US has currently, which it has to service. So let's hope sanity prevails. But yeah, it can happen in a democracy too, if the people in charge don't care about sanity. Right, so that gets through Alberto's questions. So now let's switch to your questions tonight. So there's a new super chat tonight from Rocky Cottage. Oh, and don't forget, like and subscribe. And Rocky Cottage, what a nice name. Rocky Cottage says, any reason not to move tax-free cash from a SIPP, self-invested personal pension, currently in cash, money markets, to GIA, low coupon gilt ladder, rather than start a gilt ladder and a SIPP with uncertainty over threshold change? Thanks. Well, you could take out your tax-free cash. I guess, I mean, if you, okay, so rule change recently is that you can't inherit a SIPP. So a lot of people who are planning to pass on their SIPP to their children as a way of avoiding paying inheritance tax, that's no longer possible. So it just forms part of your normal estate. Usually that amount where the threshold kicks in for people to pay inheritance tax is about $1 million, assuming that you've given the family house to your kids and also that one spouse has predeceased the other and inherited their pension allowance. So once you cross that $1 million threshold, then you may have to pay tax on the inherited pension along with the other assets that are inherited. So that's what we're really talking about here. Removing the tax-free cash in order to reduce the size of the pension, because now remember it's better to spend it because, hey, it's yours, and it's not a tax-efficient way to give it to your kids. And it may well be double taxed if your kids are additional rate taxpayers, because they'll have to pay tax on the income that the pension generates, as well as paying inheritance tax to receive the cash. But if it's for you, then yeah, why not invest it in a low coupon gilt ladder? The reason why we choose low coupons, of course, is because the special thing about gilts in the UK is that you don't have to pay inheritance tax. So let's have a look at the UK yield curve just to illustrate that. You know, where we are right now with yields, because I think it's always useful to see where we stand. I'll have to share here. Yeah, there we go. Right, so this is our macro monitor. So if you are a member of our online community, if you're a premium website member, if you want to learn how to join, just go to pensioncraft.com/membership. You get access to all of these trackers, right? So macroeconomic ones, one for the fair value of gold, the current price to earnings multiple for the US stock market, and lots of macroeconomic indicators as well. So let's drill into the macro trackers. And we've also got the app. I won't show you that, but that's cool. So here's a UK yield curve. So this is where we stand now. So the maturity of the bonds is on the x-axis from 0 years to 50 years. The y-axis is the yield of the bond. Now, this doesn't show you what it looked like about a month ago, but what I can tell you is that the belly had a bigger dip in it. So the belly has shrunk. So the yields have moved up at the 5-year point. They kind of moved down at the short end of the curve. And so what we're starting to see is a curve that's going back to being upward sloping. So, that's kind of a return to normality. But if you want to buy a gilt, what I've done is I've shown the size of these blobs. Each of them is one UK gilt. There are about 64 of them outstanding. Bigger blobs like this one have a low coupon because these were issued when interest rates were near to zero. And there was a long period in the UK when that was the case, and in the US. And what happens when a bond is issued is it freezes in that part of the yield curve into the coupon when it's issued, and it stays frozen in. So all of this batch of bonds which are now maturing, many of them have been issued with very low coupons. And because the yield curve is roughly flat at 4.6%, it's not quite flat as we saw, it's got a kink in it, but let's pretend it was at 4.6% flat across the curve. What actually happens is if the income is lower, the capital gain is higher. They add up to 4.6. So low coupon means high capital gain. High capital gain means you don't pay tax. So that's why you choose a low coupon gilts. And again, this is one of our trackers. And this is the form of a table. And you can specify the coupon range and filter the bonds. So let's filter for coupons less than 0.5%. So these are all low coupon gilts. All of these are very tax efficient. So let's just choose one. So TN28, can you see the coupon here is 1/8%? It matures in 2028 on January the 31st. You pay today 88 quid, £88 for every £100 of debt that you buy. At maturity, you get 100. So 100 minus 12, you get £12 of capital gain guaranteed if you hold it until January the 31st, 2028. So that's about a 4-year period. So 12 over 4 is about 3% per year capital gain. Do the sums properly and you get 4% capital gain yield. Only 0.14% income yield. And those two add up to the total yield to maturity, which is currently about 4.2, right? So you can choose these low coupon gilts and pay very little capital gains. And if you want to compare with something like a money market fund where you would have to pay tax, you have to gross it up. So if you're an additional rate taxpayer, remember you're saving that 40% in tax because you're not paying any capital gains. So you'd actually have to have a much higher rate of return, about 6 or 7%, if you're an additional rate taxpayer to get the same net of tax income that you would with a gilt. So I think that makes actually a lot of sense as an investment right now. It's a real question though whether it's worth waiting, whether yields are going to go up or down. I don't think it's as clear cut as people make out. And in fact, I've just shot a video for next week about reasons why rates might go up from here, which is very much, I'd say, a possibility which is being ignored right now. But I think the path to higher rates from here is actually quite plausible. I don't think it's an absolute cert that yields are going to come down. So I just think, anyway, if you watch the video, you'll hear about what I think. But your question is about whether it makes sense to put money into a gilt ladder. Yeah, if you're not worried about it being a low income, low return, very safe investment, but tax efficient, certainly. But what you do with that money, remember, if you do put it into stocks, say, and you make a loss, you can write off a loss against future capital gains. So that's one of the benefits of a general investment account. There are limits to what you can buy to replace it, but that is one of the benefits of investing in stocks in a general investment account, being able to write off capital losses. Remember, capital losses only happen when the loss is crystallized. So you have to sell it, A, and B, you have to report it on your self-assessment. If you forget to report it, you can't write it off against future losses. There's a certain period of time over which you can report it. After that, it can't be used. So just remember to report the loss on your self-assessment. But is that a good plan? Well, yeah, certainly it's tax efficient, but you know, you could always invest in stocks as well. But if it's already in a money market fund and cash, then you're moving it from something which is safe to something else which is safe, which is a gilt bond ladder, where you hold the stuff to maturity. So yeah, that would be appropriate, I'd say, because you're not changing the risk profile. Next person, Rajasilan Ganeswaran. Thank you for your super chat. He says, a subs teddy for our favourite cockapoo. Maybe that would be a good time to summon the dog. It is roughly half time after all, and we'll give him a treat. I'll just hammer on the floor so Laura knows that Teddy's being summoned. And remember, the reason why he does this, he comes upstairs to get a treat from me. I just give him these lousy low-fat treats. She gives him the proper stuff, which is biltong, which he really likes. So you watch. He doesn't like these because they're low-fat. These are slightly higher fat. Teddy. Hello. Good boy. Oh, look, a treat. Yes. Very good boy. Right. And we're also going to do the trick. We're going to do the standing trick. He's recently expanded his repertoire of tricks. He can also stand now, so which is quite useful. When I dry his paws after he's been outside, is that good? You enjoy it? You want another one? One more. Yeah, so he stands now, which is very good. And he also does rolls. He's very good at the rolls. Oh, wait. Very good. Good boy. Right then, you want to go back to Laura? Oh, he's listening. Is she going? She's going to let you in. There we go. Going to go back downstairs, friend. So I'll tell you one of his super skills. When I give him worming tablets, I hide them in cheese, and he can selectively eat the cheese while remaining completely free of the worming powder. I don't know how he does that. Incredible. So I have to crush up the tablets, embed them in the cheese, and just hope that he eats it. He's very clever when it comes to that. Brilliant. Right. So yeah, please like and subscribe. And it's a question from John Close, a super chat. Thank you, John. John says, hi Ramin, I have some cash in Vanguard's money market fund and I'm planning to move it to one of the 6 Vanguard bond index ETFs or funds when interest rates drop. What do you think of them? Okay, I mean, we can have a look if you like. We can have a look at the Vanguard ones. And maybe it's helpful because I can just talk through what I'd be thinking when I'm considering, when I'm thinking about investing in bonds. So always with bonds, what I love about them is the risk and return is very clear because you know what you're buying, you know very clearly what the risks are, and usually the yield will be quite fair. So let's have a look at what we offer. So if you want to filter just for the bonds, you do building my own portfolio, bonds. Do I want the active ones? No, I don't. Okay, so let's just filter by accumulation just to kind of reduce the choices. So we've got bonds, we've got index, we've got accumulation. So this is what we've got. ESG I personally don't buy, but if you're worried about environmental, social and governance issues, then you can selectively buy funds which will filter based on companies which pass certain ESG criteria. Corporate bonds, What are the risks? Well, firstly, you're taking interest rate risk because there's a duration of the fund. You've locked in a rate for some period of time. If interest rates increase, the price goes down. So there will be volatility as a result of that. My guess is that this is an investment grade corporate bond fund. I think all of the ones from Vanguard in the UK are investment grade. Some of them are hedged. Some of them aren't. But you'll see that if it's hedged, it'll say in the title, hedged accumulation, which means that you're not taking any currency risk. Because remember, why you buy bonds usually is that you don't want a lot of volatility. You want it to be kind of ballast in your portfolio to protect you from those economic storms. So if you currency hedge it, you're removing some of that volatility. So dollar versus sterling, the volatility is usually around 12%, 10%, something like that. And that volatility will be taken out of the equation if it's hedged. So the price will be much more stable. I'd also be looking for a low fee. So these are all reasonable, 0.09, 0.16, 0.18 for this one. This is a global corporate bonds index fund. And then you'd also look at where the exposure is. How much is US? How much is UK? If it's a corporate bond fund, or if it's a government bond fund. So this one is purely Japanese government bonds, for example, which currently, I'm guessing, yield very little because Japan was in a low interest rate environment for much longer than the rest of the world. So yeah, that's probably not very attractive. UK gilts, so you can buy one of these. What it's also worth doing is trying to find out the duration of the fund. Now, Vanguard is useless when it comes to reporting duration. Even if you look at the fact sheet, I think it doesn't give you the duration. It does give you these ridiculous risk numbers, which I think are almost useless. But if you look for the word duration, it doesn't even occur in the document. What I usually end up doing is copying the ISIN code and then going to Morningstar, which is usually pretty good. It gives the duration of the fund. So here we go, VGVA, and if I look for the word duration, here it is. Yeah, so the effective duration is 9.34. So if interest rates increase by 1%, the fund price will go down by 9%. If interest rates fall by 1%, the price of the fund will go up by 9%. So 9 years duration is quite chunky. So you'd have quite a bit of volatility with this fund. So just be prepared for that. But that's the biggest measure of risk. The most important measure of risk for fixed income is duration. So that's another thing I'd look for in the fund. So what are the risks? Are you getting credit risk? Is there a default risk? Because if there is, then when equity sells off, probably credit spreads will widen and the price of the bond will fall. If it's a government bond fund in developed markets, then it won't suffer that fall. It'll probably rally, assuming it's not something which threatens debt as well as equity, like high inflation, say. So that's the other thing. Is it government bond or corporate bonds? And what's the issuer risk if it's corporate bonds? And then finally, is it currency hedged? And I think most of the ones from Vanguard are currency hedged. Are you taking a currency risk with this investment? Because if it's supposed to be safe, you probably don't want to. And yeah, work out the duration because that'll tell you how volatile the fund is. Long duration, very volatile. You know, if it's long duration gilts, for example, it could be as volatile as equity. So you can take a punt on which direction interest rates will move. But I'm not sure I could call that one way or the other, even right now, when everyone thinks it's going to go down in terms of yield, certainly at the short end. I'm not so convinced. I think there is a case to be made for it certainly staying where it is now for a while. So there we go. You know, I probably wouldn't try and guess which way interest rates are going. But if you did want to lock in a rate, one way to do it is with single gilts. You can't do that on Vanguard's platform because they don't let you buy gilts. you can on many other platforms. Interactive Investor, for example, or AJ Bell, I think, has them. iWeb has single gilts, and Interactive Brokers, I think, has them. And there's one other, Hargreaves Lansdown. So, just find a platform which doesn't charge you much. I think the charge for trading on Interactive Investor is $3.99 a trade, so very low. I think it's a bit higher on Hargreaves, unsurprisingly. But yeah, you need a platform where you can do it. But a gilt ladder is another thing to think about, rather than a gilt fund or a bond fund. But those are the risks that you're trading off. Do you want a bit more juice with corporate bonds? Do you want to currency hedge it? And what kind of risk do you want to take regionally? And what's the yield you're getting? That's really important. The income, is it sufficient for the risks you're taking? That's the decision. And I can't really tell you what to think there. You've got to judge for yourself. If you do want to go down the risk spectrum, then you go to high yield corporate bonds, which you can't buy on Vanguard. They do offer an emerging market bond fund, but that's higher return because it's higher risk. Emerging markets often have crises, and that leads to sell-offs in those indices. So just remember you're trading off risk and return as always. Next question is from Dan Veneri, who says, do you have a SIPP account? If so, which one do you use? I'm considering opening one. Well, don't copy what I do. I do have a SIPP, and it's on Vanguard. Often people ask me, do you get paid by Vanguard? No, I don't get paid by Vanguard. And the reason why I stuck with Vanguard is because, they're kind of safe. And when I first opened the account, they just opened their UK platform to UK investors when I started PensionCraft at the end of 2016, beginning of 2017. So I thought, yeah, I'll give it a go. And then I wanted to make a video about SIPPs, and they opened up their SIPP. It took ages. They finally launched it. I think it was the next year. And I tried it out just to make an example video, which is still on YouTube if you want to watch it. And I've stuck with it, right? And I've consolidated my pensions onto that SIPP in Vanguard. And I've also got an ISA on Vanguard. And if you the maximum you pay across all of your platforms on Vanguard, across all of your accounts, is $375 a year, which is pretty reasonable. I've hit it already, obviously, after I consolidated my pensions. And yeah, so it's pretty low fee for me. It's not the cheapest, but it's okay. The app's okay, not great, but it does restrict what you can buy. But I only buy one fund on there anyway, which is VHVG, so it doesn't restrict me that much. But I also have my fund portfolio, which is on Trading 212, and I've got other accounts, Invest Engine. When I was playing with bonds, I opened up an account on Interactive Investor where I bought a gilt, and I bought an inflation-linked gilt. It's now sitting in a money market fund as dry powder, and I'm thinking about moving it into gilts at some point, but maybe not yet. So I do have a SIPP account, but all I'd say is shop around, find one which has got what you want in terms of investing, make sure it's got the funds that you want. Vanguard is restricted to just their own funds, so just make sure that's not a restriction for you. No stocks. Other platforms have ETFs, some of them have gilts, I mentioned some earlier. So just make sure it has what you want. Fees ideally should be low, so all in, fees should be less than about 0.15%, maybe 0.2% ideally. But nowadays there's so much competition between different platforms, you probably find a low fee platform that suits you. If you have a large amount to invest, and here we're talking 100,000 or more, maybe 70,000 or more, make sure you don't pay a percentage fee, because that can become incredibly expensive. If you've got less to invest, a couple of thousand or 10,000, then a percentage fee isn't so bad and maybe cheaper. So just work out what the percentage is. It's dead easy, total amount times the percentage per year, and compare that with a fixed fee platform to see when you cross that boundary. But once you go past about 70k, I think, or 60, 70k, the fixed fee platforms start to become cheaper, and then they just get cheaper and cheaper and cheaper in percentage terms. And if you have a large amount to invest, never, never, never go for a percentage fee. The other trick on Hargreaves, if you stick to ETFs, you get capped your fee. It doesn't go above a certain amount. If you've got funds, they're charged as a percentage. So just be aware of that distinction. If you look at their revenue from Hargreaves, the last time it was published, it won't be published anymore because it's now a private company. You could see that half of the revenue from platform fees came from people who owned funds, which I think is worrying given that you can get exactly the same exposure with ETFs for a fraction of the fee, holding fee on Hargreaves. So I think a lot of people don't know that distinction in the way they charge people. Other platforms don't do that. For example, on Vanguard, whether it's an ETF or a fund, the fee's the same. And other platforms are ETF only, like Trading 212, like InvestEngine, for example. So there is no right or wrong answer about the SIPP platform. You just got to find one that suits you with a reasonably low fee. The next question is from Rajaseelan Ganaswaran again, another super chat. Thank you. He says HSBA is up. Still worth it for the dividends. Right. So let's have a look at that. Oh, webcam, wrong one. Right, so this is what I use for single stock analysis. It's Stockopedia. And incidentally, if you want to buy Stockopedia, there's a description. If you look in the description, we've got an affiliate link, so we get paid a small amount, but you get a discount if you use it. So let's have a look for HSBA. What I like about it is that it summarizes the balance sheet of the company and its fundamentals, and it comes up with this stock rank, which tells you compared to the rest of that market, in this case the UK. There are other regions, of course, Australasia, Europe, US, Canada, but relative to the rest of that market, how does the momentum of this stock look, both in terms of earnings and price? How does the value look? So high rank for value means it's cheap. So this one does look pretty cheap. It's on the 88th percentile. Quality, not so good. So it's increased recently over the last month, but still 60 is not great. But yeah, you can see that the momentum is positive. It does classify as a super stock, which means that it ranks well on several of these criteria. And the stock rank overall is 96. So from that perspective, yeah, looks like a pretty good stock. And I'd certainly consider it. Obviously, my portfolio, the one I've got at the moment, is a UK small cap portfolio, which I created using a screen on here, where I was screening for small caps, so small companies, which are also high stock rank. So they've got good fundamentals, they're cheap, they're high quality, and they're trending upwards in terms of news about their earnings, but also their price. And this is what's in it currently. But I created that with the screen on Stockopedia. So this is the screen I was using. So these are the criteria for the screen, and it's only stocks which fulfill those criteria sorted by stock rank. So if I were to get rid of one of them, or one of them fell out of the criteria for whatever reason, one of them was recently taken over, for example, an energy company. So I'd come back to this list, I'd scoot down till I get to energy, and then I'd find a substitute for the one which has been taken out. So I can't see any energy ones on this first page. So I'd go to the second page, hopefully there is one. Okay, yeah, so hunting I already own, I think. Yeah, so that would be the one I'd probably end up with. But that's the way I kind of use it. But certainly HSBA, yeah, looks pretty good. And it's got a pretty good stock rank. So yeah, I'd say that qualifies. So anyway, if you are interested in it, you get a free trial of Stockopedia. And like I said, the link's in the description. Back to your questions. Gerard McCann says, should we buy the dip in gold or more to fall? Thank you. Well, again, let's have a quick look at the fundamental value of gold. Now, of course, gold doesn't produce cash flows. It's a wasting asset. So we can take a look at a model based on the strength of the dollar, strong dollar, bad for gold, based on interest rates, high rates, bad for gold, and CPI inflation tracks gold. Gold tracks CPI inflation over the long term. And you can see that gold's still overvalued by about 19%, according to this. So that's based on the price on November the 12th. That's 2 days ago. And you can see it has fallen a bit. Let's zoom in a bit. So there has been a slight fall from the peak, but not a huge one. But it's still expensive relative to the models. So the model's forecast is in red. The actual price of gold is in blue. So the model's saying something like 2,200. So if we look at today's price of gold, gold spot price, let's get in dollars. Have we got a graph? Have we got a graph? Well, that's fairly recent, so it's above 2,000. Let's see if we can find it by not saying gold price. Maybe it'll be on Yahoo Finance. Maybe it'll be on here. Here we go. Yeah, so that's XAU GBP. I want XAU USD. Sorry. Here we go, trading view. Yeah, so currently 25.75, and the model is saying no, don't want that. The model's saying 21.87, so quite a bit lower than the latest spot price. So personally, yeah, I think it still looks like it's baking in a little bit too much euphoria into gold. It did take a bit of a setback as a non-risky asset when we had the Trump victory, but I'm not convinced that, you know, it's still above its fair price according to this model. So personally, I'd probably avoid it. I did make a video recently about how to buy gold if you're interested, so that's one of our recent videos on YouTube. Next question is from BLH Low, who's done a super chat. Thank you. She says, fact sheet of PIMCO Income Fund states that it has an effective duration of 3.2 years, so pretty short, and a yield to maturity of 6.4. Breakdown of the duration: 1 to 3 years 36%, 3 to 5 29%, 10 to 20 about a third, 20 plus years minus 17.3. How do I interpret the negative long duration maturity? Also, does the yield to maturity look too high? I think what we've got here is an interest rate derivative. So duration, remember, is the multiplier. So regular bond, you've fixed in a rate of income over some period of time. If the actual rate of income for other investments goes up, your bond looks less attractive, so the price of your bond goes down. So when you're receiving a fixed rate of income, an increase in yield reduces the price of the fund. How about if you were paying an income? Well, that reverses everything, and that way you get negative duration. How could you do that? Well, you can do it with something called an interest rate swap. So if you have a receiver swap, it acts just like a bond. Yields go up, price goes down. But if you have a payer swap, it's like you've issued a bond. And if interest rates go up, the price of the instrument goes up. So the duration is negative, which is a bit weird. But it sounds like what they've got here is a portfolio of bonds, and then they've overlaid a swap in order to hedge out the interest rate risk at the long end of the curve. And that way, they're just doing that to manage the interest rate risk. So the overall risk is 3.2 years, despite having bonds which are 10 to 20 years in it. About a third of it is 10 to 20 year bonds. But the the payers swap, get it right, the payers swap is reducing the overall duration. So that's all they've done. They've just done a little interest rate derivative overlay. Does the yield to maturity look too high? No, I mean, that sounds reasonable. If we look at the UK, for example, currently bank rate is what, 4.75, I think. So even if you have a risk-free or as close to risk-free as you can get with the money market fund, you could currently earn 4.75. So 6 means that they're taking some credit risk somewhere, or at least they're going for, yeah, I guess they're taking credit risk to generate that extra yield. But that's how they're doing it. And also hedging away some of the interest rate risk because they don't think that's attractive at this time. Or they just want a low volatility fund. Next question is from Rio Carl, who says, he's from Canada. He says, I'm investing in an ETF, which is ZGQ, with dollar cost averaging each month. Only holding this ETF. Any thoughts? I'm not familiar with it. Let's have a look. So it's an all-country world high-quality fund issued by Bank of Montreal, and it's tracking MSCI ACWI. But it's a high-quality version of ACWI, which is tracking the MSCI ACWI Quality Index. Remember what you can do with, if it's an MSCI index which it's tracking, you can always go to the index provider and download the fact sheet, which is great because you can look at the back tests, you can see the back historical returns of this thing, and you can see that it's beaten All Country World Index, which remember is developed and emerging markets. It's beaten it fairly comprehensively over the last 14 years, 15 years. And it goes back even further. It goes all the way back to 1994. And in fact, it's beaten the All Country World Index, the quality version's beaten the All Country World Index by a fairly resounding, 3.4 percentage points, which is chunky over that period. Now, if you look at quality at the moment, it doubles down on tech. So Nvidia, Apple, so you get even more of those than you do with an all-world index. So that's what puts me off quality at the moment. It screens for mega cap tech, the Magnificent Seven, and it increases the concentration, which is already high in those stocks, which I'm not really happy with. I'd rather wait for a big sell-off in equity and then load up on quality in my fund portfolio. But at the moment, I'm holding off on quality. And as you'd expect as well, the US makes up 71% of the index. So it's still very US heavy, tech heavy. But, I love the idea of quality. You buy companies which they've got a good return on equity. They generate a lot of profit for every dollar of equity that you put into the company. They've got stable earnings growth, so their profits are increasing steadily. And they haven't got too much leverage, which increases business risk. And who wouldn't like that combination of factors? The only factor which it doesn't incorporate is expensiveness. And you often end up overpaying for quality because you're not the first person to notice those are good companies. So I think a combination of quality and value, or even better, quality, value and momentum, which is what you can do with Stockopedia, which is what I've done for Stockopedia. I've got a value, momentum and quality tilt in my UK small cap exposure. Although I have to say it hasn't been doing very well recently. But still, quality as a style, yeah, I think it's great. I love it. But all I'd be concerned about is overpaying for it at the moment. Back to your questions. And thank you for all the super chats, by the way. I appreciate that. ENP has super chatted. He said, thought on Invesco's equal weighted MSCI World ETF. Oh, interesting. I haven't come across that. But okay, the problem with equal weight is Yeah, MSCI World Equal Weight Index. Here we go. So let's have a look at it. Let me just explain what it is first of all. Normal indices will be market cap weighted. If a stock has twice the market cap, it'll have twice the weighting. A global one currently will have a huge weighting to companies like Apple, Microsoft, Amazon, the big mega cap tech stocks. If you equal weight, then if you've got 1,000 things in the index, then you just weight 1,000th of the capital into each of the stocks. So you get less of the mega caps and more of the micro caps, or mid caps usually is what it gets to. So let's have a look at how this is weighted. So it's got the same constituents as its parent, which is large and mid cap securities from 23 developed markets. But instead of market cap weighting, it's tilted towards the small caps, which are currently quite cheap. So this is also a value tilt at the moment. And if we look at the top 10, oh, look, it's not Apple. It's Applovin, which we've never heard of. So I think that's the problem, which is that you may not recognize these names at all because they're small caps. MicroStrategy, better known because it's the big Bitcoin buyer. But look at the weights of these stocks, 0.14, 0.13. All of them are kind of close to the average because they all have the same weighting. So the median weighting, for example, is 0.07, smallest is 0, highest is 0.07. So the average is 0.07 because there are 1,400 stocks in the index with equal weighting. So just be aware of the fact you're having a huge tilt to small caps. So you can see that here with the factor tilts. You've also got a tilt towards value because those are currently quite cheap relative to large caps. As long as you're aware that those are the tilts you've got. And a tilt away from the US, a pretty big one, 43% US rather than 70 or 60 for MSCI ACWI. Japan looks pretty much in line with market cap, but a lot of Canadian, a bit more UK. The other bits look quite similar. So yeah, those are the risks you're taking. So if you think this mega cap growth story is going to continue, which it seems to be for now, then this thing won't do particularly well. And you can see recently it's been massively underperforming MSCI World over the last decade or so. If you think that value is about to make a comeback, yeah, this could be interesting. And if there isn't going to be a big economic problem globally, a period of weak growth, which hits small caps badly, then yeah, this could be interesting. So those are the kind of risks you're taking with that tilt. But interesting index. I hadn't come across that one before, that specific one. Last question, because we're pretty close to time. Concon MCMC, a regular viewer, thank you for your super chat, says CSH2 accumulation taxed as interest or capital gains. Is there a way to avoid paying income tax rate? I have a lump sum, 150k, I need to invest or park, money not needed soon. What would you do? Okay, what would I do? I put it into a gilt bond ladder because you don't pay capital gains even if it's out, if it's outside an ISA or a SIPP. The return will be similar to a money market fund if you use short-term government bonds. Remember, if you roll over gilts up to a maturity of about 6 months, the return will be almost identical, very similar to a money market fund. There's not much duration, so there won't be much volatility. You don't care about the volatility anyway because you're holding to maturity. So very capital gains efficient. If you do want to make it even more capital gains efficient, go for low coupon gilts. Use that filter that we've got on our tools. If you're a member of our community, you can do that. Or just search or just look at the list of gilts and look for low coupon gilts and just roll those. So that's how I do it personally. We've got another question. Just saying hello. Okay, good cue. Just saying hello. I appreciate that. Thank you for the super chat. And yeah, so that's probably how I do it. And yeah, but CSH2, you'll get something called excess reportable income, which means that the dividend which it pays, which is then reinvested back into the fund, still incurs tax, income tax, and it's treated as interest. And we've had a thread about this in PensionCraft before, but just Google excess reportable income. Usually your platform will give you a report just before the tax filing date, which breaks out your excess reportable income for the stuff in your general investment account. Of course, if it's in an ISA or a SIPP, you don't have to worry about that. And I never invest in a general investment account for that reason, because I don't want to worry about ERI, excess reportable income. But if you just Google ERI, there's a very good article about it from Vanguard. Ideally also have a platform which does the report of ERI, because it'll help you fill out your self-assessment. Or get a tax accountant, because they can help with that too. But that's the way it's treated. You don't avoid having to pay interest, income tax on the interest. And of course, if you buy low and sell high, maybe there'd be a capital gain as well to consider. Although for this, of course, it's fairly limited because it's a money market fund. But the particular breakdown, your platform should report what that is. So I hope that helps. Thank you all for joining us. Don't forget, we've just soft launched our app. Let me just give you a quick preview of what it looks like, just to see what our members see. And you too could be a member. So you go to your dashboard, which is where all the fund membership stuff happens. We tell you about our new upcoming events. You see your courses that you've bought. And we've got a new button, which is Launch the Tools app. And this is what it looks like. And we've got some off-the-shelf strategies. Now, what's the difference between a strategy and a portfolio? Well, a strategy also includes rebalancing. So if you rebalance once every year, 2 years, 3 years, 4 years, the returns are quite different than if you don't rebalance at all. Or if you assume that you've got annual rebalancing or daily rebalancing, some people assume. So you can enter your own strategy. So you say what you want to buy, you give the allocation, or you can use one of these off-the-shelf strategies, and you choose the time period, and then it comes up with the strategy performance, the downside risk. It gives you the real return as well as the nominal. It plots the risk and returns of the ingredient, in this case, just one. It also gives you a cladogram, which tells you the correlation to the other assets in the portfolio. And there's also this Monte Carlo simulation tool for saving and for drawdown, to help you plan your withdrawals and work out the chance of running out of money on retirement, or the chance of reaching a target if you save a certain amount before retirement. So, we're quite excited about it. It was a soft launch. It's only for members. If you join our membership now, you will pay that low membership fee, which we haven't increased for 4 years, despite inflation everywhere else. You'll lock that in while you're a member, for as long as you're a member. But in the new year, we're going to increase our fees because we haven't done for 4 years. And that's only for new members. So if you get in before we do that, you can lock in a lower membership fee. And it's not very high anyway, right? We try to keep it low so that more people could join our community. But yeah, it's going to go up. So if you are going to join us, do it before the new year is what I'd recommend. But we will be talking about that again in future. And you get a voice when it comes to developing this app, because we've taken feedback from our members and we're going to incorporate that in the app as we develop it with the collaboration of our community. So that way we can ensure that what we produce is what people want. That's the idea anyway. So thank you all for joining us, and please do like and subscribe, and we'll see you at the next live stream. Take care, everyone.